It's a pleasure to be here tonight. I thought what I would do is start to frame some of the discussion and some of the information that you'll hear from some of the other speakers in terms of what we see happening with the capital markets and the strategic markets. And they are always in flux, and we're entering a very interesting time. And I think some of the slides and the comments I'll make will illustrate that. So I think the first slide I wanted to show is what I call our spaghetti slide. And what it really looks at is what's happened over the last year in terms of different aspects of biopharma. And what I've done is broken up sort of biopharma into 4 distinct buckets. One is large cap major pharmas, such as AstraZeneca. One is what we consider large cap biotechs, and that's coming out of an index called the MBI. Mid caps, which we have a very liberal definition for, which is really any company that between $1.5 billion US and 10 billion US, and then what we call small caps. And what's interesting is that if you would have looked back over the last few years, it would have been very different looking and would have actually been inverted. And the small caps would have been actually outperforming significantly the bigger companies. What we've seen over the last year, and specifically at the end of last year and now for the better half of the last 6 months, has been a change in investors' threshold for risk. And part of that is due to some other factors I'll touch on in a second, which is that the macro environment has become a little bit more risky. And obviously from a emerging biotech perspective, those companies in and of themselves are very risky, given that none of them have any fundamental financial valuations that you can use. Very few of them have revenue, no earnings, EBITDA, any other metrics. And so it's a very emotion-driven sector. And so you've seen that as tolerance for risk has changed, so has the valuation of those companies. And companies that are bigger and a bit more financially strong have outperformed those companies. And this has several other implications that we'll touch on in terms of capital raising and also strategic dialogues. So what we also wanted to see is where are investors putting their money? And so what we tried to do is divide up the companies by their main therapeutic area of their lead programs. And what's interesting, and I'll throw out 2 different aspects of it, we broke out oncology into 2 different areas. One is sort of non-immuno-oncology, and the other is immuno-oncology. And I think that's really illustrative of what we're seeing in the market, because what we've learned over the last few years is how complex immuno-oncology actually is, and how difficult it is to predict what companies will have success and which won't. And in fact, even if it's the same, in theory, scientific rationale is the same, you often get different clinical outcomes. So what we've seen is, again, immuno-oncology has underperformed because investors think that there's too much risk associated with it, and they don't know how to predict which companies are going to be successful. Whereas targeted therapeutics, specifically in oncology, have outperformed all the other areas of it because it's actually had a lot of success lately in some of the companies in that area. But more importantly, investors believe they can predict success much more readily than they can in other areas. And so I just want to highlight that as an illustration of how therapeutic categories are also differentiated by how investors appreciate the risk in those areas. Obviously, an aspect of this is as you go up and de-risk a company, what happens to valuations? And so what we've tried to look at is again, divide up the companies based off of where they are in stages of development, from sort of phase 2 proof of concept through data that suggests that they can enter phase 3. Phase 3 data is with potentially an NDA or BLA filing, and then companies that are marketed. And as you can see that the curve steepens greatly as companies are de-risked. What I would say is that what's interesting is that the commercial stage companies actually have a little bit lower valuation than you might think that a commercial company would. Part of that is because there's a bit of, the data is going to be a little bit flawed because a lot of the companies that are successful get acquired when they're at the early stage commercial, and so some of the better companies aren't going to be part of this analysis today because they've already been acquired. And also that one of the things that I think investors specifically have learned, and that's where the valuations are somewhat capped, is that commercialization is really hard. And if you try to do it with a small organization, it's not that easy to be successful unless you have a product that's highly differentiated and you're not competing with other companies that already have strong commercial relationships. So that's one of the key aspects that we take from this slide. I won't touch on this slide, but other than to say that the comment I made before about the macro environment, obviously equity markets are highly focused on US trade, the upcoming election, and we'll get to that in a second, and then monetary policy amidst a slowing global economic outlook. And again, these are the risks that investors see, generally speaking, and then when you layer on biotech risks, it's why we've seen some of the results over the last year. One thing we wanted to look at specifically is what does the election cycle mean for biotechs? And so what we did is we went back and looked at the last presidential cycle. And what you really saw was that from the fourth quarter of 2015 through the election and what we call through the sort of first 100 days, the environment for raising capital, whether it be an IPO or a follow-on, was highly diminished relative to what it had been leading up to that. And so what we expect is probably similar result over the coming year. And that is partly because of at least in the US election, what we believe will be a lot of rhetoric with respect to pharma pricing and reimbursement and things such as that. And again, that coupled with all the other macro risk factors creates more risk for companies that have products that will potentially be impacted by that. And so I think what we are expecting is a very similar looking graph to this and chart. Finally, it's been an extremely robust financing period, and we started to see, if you look at the Q3 and Q4 numbers, you're starting to see slowly a slowdown in that, especially when you look at follow-on offerings relative to IPOs. I think the IPOs are a bit skewed because many companies are trying to aggressively enter the market while there's still an opportunity to do so. And they're fearful that as we turn the page into 2020, that environment will become much more challenging. And so the follow-on market, I think, is a little bit better barometer of where the overall market is in terms of receptivity to capital raises. One of the most important things that we've seen over the last decade has been a change in the ability of companies to raise significant amount of capital. And some of you have seen this slide because it's one of my favorite slides that I ever present, because I think it is very instructive in terms of how companies are now oriented in terms of what they're able to do on their own versus what they historically were able to do on their own, as well as what that means for strategic relationships, whether it be M&A or business development. And what we've seen is that the amount of capital companies are able to raise in just one financing, sort of overnight, has gone up appreciably. And really when we tried to show that if you go back a decade, there were very few companies that were able to raise more than $100 million over a course of a whole year. What we see now is if you look at that same criteria, just year to date, there have been well over almost 50 deals, and this is even dated. I think there have been some transactions this week already that would make this number, but over 50 deals that have been over $100 million for companies being able to raise. And so what they've been able to do is develop those products on their own without looking for partners. And so what you've seen is that's led to companies taking it on their own and therefore leading to potentially more M&A, or at least the option for M&A in the future, because they haven't diluted the asset through a partnership earlier on. And obviously, as capital markets become more difficult, this chart will change dramatically, and that may shift back to the need for companies to think of other ways to get the capital they need and the relationship they need in order to develop the products along the way. So that's something that we're very focused on looking at over the coming year and then plus. Finally, touching on M&A for a moment. Really, M&A has been skewed by a number of big deals over the last few years, as opposed to the volume of sort of mid-sized and small deals. This year alone, we saw, basically two very large deals that have been the focal point of the M&A volume in general. But I think, one thing we're looking for is that as those deals have been completed, we don't believe there's a lot more necessarily a lot of consolidation, and we think this will be more volume in terms of number of deals as opposed to few selected big deals. So that's something that we're looking to see as that evolves going forward. And finally, what's happened in terms of the M&A processes themselves is that they've become very focused and much faster in terms of how they've evolved. It used to be that any company that was for sale would in essence run an auction with all the usual suspects, looking at how that deal, trying to extract the most value. What we've seen is it's changed a lot, and sort of the board's fiduciary duties have changed in terms of how they get comfortable. And what we've seen is that one party usually will stimulate a process with a fairly robust offer that will limit the number of other parties that can participate, and a deal will happen in a much quicker timeline than what we've seen. And there'll be some bid progression, but not substantial differences in most deals. And that's one of the things that, again, has changed dramatically over the last few years, and therefore how companies interact, the larger companies and the developing companies, they have to think about that relationship in a different way than maybe historically they had, because companies like AstraZeneca would always get a call in the past. Nowadays they may not, unless they've shown some interest beforehand and have developed some relationships. And so it's an interesting tightrope that some of these companies have to walk before try and show too much interest versus just showing enough. And so that's sort of my prepared thoughts, and hopefully it sets the framework for some of the other speakers.
Thank you very much, Ross.